Hello and welcome to The Quality Investor. With earnings season in full swing, I will be providing commentary on some of my holdings as well as some market bellwethers. This is to ensure that the investment thesis I have for my holdings remains intact. Texas Instruments, ticker TXN, released their Q3 2023 earnings earlier this week, and the sentiment around these earnings was not good. It ranged from what is going on to panic, and objectively speaking, they were weak earnings. The main contention that I saw surrounds the safety of the vaunted Texas Instruments dividend. A narrative seems to have formed around the usage of debt to pay for their dividend. And on today's episode, I want to address the earnings report and provide context for the weakness that we saw there. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. So regarding that dividend narrative, we have this person on Twitter who posted investment portfolio update. I sold Texas Instruments due to the results they showed. I'm afraid that in the near future, the company may cut its dividend, just like Intel did. Another person writes, not sure if they have done it historically, but recurrent dividends are higher than their quarterly free cash flow. They are taking debt to pay divs and also increase them by 5%. Don't really like it. Shareholders know about CapEx. Just put all of the cash flow toward new fab. However, poster Heavy Moat Investments brings a little bit of levity to the conversation. I honestly find it hilarious how many people are getting scared out of Texas Instruments after not doing their research. I can't take the CapEx arguments seriously while they announced this in 2021 and reiterated it literally every earnings call. So there seems to be a lot of people out there panic selling on the back of these weak earnings. But we here at The Quality Investor, we focus on one thing. We buy good businesses and we hold them forever. We don't let short-term market fluctuations affect our rational decision making. All right, I have open here the income statement for the 3 months ended this September. And at first glance, every line item just looks bad. So revenue is down 13.5% from year over year. Gross margin has been compressed 6.9% from 69% a year ago to 62.1% today. Operating margin has also been compressed 9.4% from 51.1% down to 41.7% today. And then we even have our EPS, $1.85, down 25.1% from a year ago. And on top of all that, Texas Instrument executives even lowered their guidance for Q4. The revenue outlook now is in the range of $3.93 billion to $4.27 billion, and earnings per share $1.35 to $1.57. All of this looks pretty scary on the surface, so let's dig in and see how bad it really is. So before we analyze how bad the situation over at Texas Instruments is or is not, let's wind the clock back a little bit to February 2023, where management released a capital management presentation outlining their strategy for the next 4 years. So first here we're looking at our company objective and strategy. Objective, maximize long-term growth of free cash flow per share, which is very important because that's probably the most important number to look at as owners of a business when understanding what you're getting out of that business. And their strategy is a great business model focused on analog and embedded products and built around 4 sustainable competitive advantages, discipline in allocating capital to the best opportunities, and efficiency, which means constantly striving for more output for every dollar spent. So this presentation is available at Texas Instruments Investor Relations page, so I'm not going to go into it in full detail. However, I do want to outline this one page here, Capital Management Scorecard Update for 2023. This lists some key financial metrics to look at as they go through this massive CapEx spending that they're going to be doing over the next 4 years. And here they have capital expenditures. So they're targeting $5 billion per year in CapEx spend from 2023 to 2026. And then after that, 10 to 15% of revenue from 2027 and beyond. And in the meantime, they're building up inventories. So maintain high levels of customer service, minimize inventory obsolescence, and improve manufacturing asset utilization. So they wanted to take their inventory levels from about 130 days of inventory over 200 days of inventory in 2023. And the other thing that caught my attention here is cash management. Provide necessary liquidity in all market conditions. Recognize there may be times for buildup or drawdown of cash. And the way they're targeting this is 10% of revenue trailing 12 months plus dividends for the next 12 months. Essentially, while they're ramping up their CapEx spend and retooling a lot of their manufacturing processes, they're building up inventories to ensure they have enough on hand to meet the demand. And they're also managing their cash so they can ensure that they pay out their dividends and possibly even continue share repurchases while they have a very large CapEx spend over the next 4 years. So let's see how they're actually doing. These charts here show their balance sheet and cash flow metrics over the last 10 years for each quarter. So if we're looking at cash and inventory in our first chart, what do we see? We see a pretty stable and steady flow of cash, and then starting around mid-2020, they started ramping up their cash. They were preparing for this way ahead of time here. And what are we also seeing? Inventory, this gray bar here, we're starting to see that build up starting around September of 2022. So they've been increasing that inventory in preparation for their massive investments in CapEx over the next 4 years. We can also see some of the results of that CapEx here. Obviously, they're clearly doing that as the PP&E has been ramped up. Coming down here to the operating cash flow, CapEx expenditure, and free cash flow chart, we can certainly see the CapEx, the gray bars here, are increasing each quarter starting in mid-2022. And it's definitely hurt that free cash flow. I mean, it's almost zero on this chart here. However, one silver lining, starting in the January of 2023, they have increased their operating cash every single quarter, despite some of their down months of revenue. However, the one negative is they are taking on debt. So that is a fact. They are increasing their debt load, and they have been since around September of 2022. So let's look at that cash management. They mentioned they want revenue from the last 12 months, 10% of that, plus dividends for the next 12 months on hand. Last 12 months revenue was 18.1 billion. 10% there is 8.1 billion, and then the next 12 months of dividends is 4.7 billion. I base that on the most recent dividends they paid in Q3 of 2023, 1.1 billion, plus that 4.8% dividend increase they announced. That gives us that 4.7. That's a cash target, $6.5 billion. Their current cash on hand is $8.9 billion. So they're over their cash target right now of $2.4 billion. We will come back to the rest of this page in a little bit, but this is basically showing the low end and high end of my Q4 2023 estimates based on management guidance. Coming over to the earnings call, the analysts asking questions were just as concerned about the CapEx as some of the retail investors out there. So Timothy Michael Arcuri, he asks, so what would it take for you to think about cutting CapEx? And I asked because the plan was put in place when revenue was quite a bit higher than where it is today. Is there kind of a line in the sand for revenue where you would consider the plan? I know that you've actually increased the plan while revenues continue to weaken. So Rafael Lazardi, the CFO, he answers, we're very pleased with the progress on our manufacturing expansion that will provide geopolitically dependable capacity to support customer growth for the coming decade. And as you know, semiconductor content continues to increase and provide us the ability to grow at that 10% growth rate that we talked about at the last capital management call, if the market requires that. We'll continue to make those investments, so we continue to expect $5 billion of CapEx per year in 2023, 2024, 2025, and 2026. Let me also give everyone, as a reminder, these CapEx numbers are gross, meaning they do not include benefits from the ITC or grants from the CHIPS Acts. So we're actively working through the grant application process with the CHIPS Program Office, which we believe will be meaningful to our manufacturing operations in Texas and Utah and will help support semiconductor growth for decades to come. And funding from the CHIPS Act grant was comprehended in our decision making for these investments. Essentially, management is saying we have our $5 billion per year spend through 2026 on CapEx, but if we do get these grants, they haven't gotten them yet, but if we do get these grants from the federal government, which they're estimating about a 20 to 25% of the entire CapEx spend, take about $1 billion of that $5 billion CapEx spend and put $1 billion back into free cash flow. Tor Egil Svanberg asks, so you talked about the operating in a weak environment. Could you also give us some color on booking trends, maybe even the current run rate versus where you think consumption is? Just trying to understand, and this goes back to Amber's question about 4 consecutive quarters of double-digit declines. So yes, any color on bookings would be very helpful. And then Dave Paul, the head of investment relations and VP, he answers, so as I mentioned, I think as part of another question on revenue order linearity, there was nothing unusual inside of that. Secondly, we're describing the environment as being weak, and we don't have a system that tells us, are we shipping above or below demand? The strongest signal that we get is orders from customers. Now, as we talked about earlier, comms, or a market like personal electronics, was the first market to go into a downturn. We've had a couple of quarters of growth inside of that market. Now, it's up off of a very weak base, but we are seeing that as a trend. If you compare that to the industrial market, we had seen that, let's call it about half of the sectors begin to weaken a couple of quarters ago. It was really this quarter that we saw that weakness is broadening. So customers, we believe, inside of the markets like that, inside of the markets like comms equipment, that we said they're adjusting their inventories as such. So again, that provides us the opportunity both strategically with building the capacity and more tactically putting in place the inventory to be able to support the next upturn, because it certainly will come. So management is essentially saying that they're not worried about what the future holds regarding their free cash and their ability to meet these CapEx requirements. They're seeing that this market is definitely weak right now, and that the bottom may be near, maybe not right around the corner. Possibly in 2024, we'll see some continued weakness. However, there will be that upturn. Semiconductors are very cyclical, and right now we're either near or at the bottom of that trough. I honestly recommend going through that entire earnings call. It was extremely informative about the current environment that we're in right now, and it really did reinforce one of my main investment theses regarding Texas Instruments, which is the absolute quality of the management they have in place at that company. So back on to my estimates for Q4. We see here in the low end of the guidance, we have a $3.93 billion in revenue. And I based my operating cash flow here on $1.13 of cash conversion, which essentially is what they converted into free cash in the prior quarter. So I just kept that flat. And the net income here, I derived that from their $1.35 of earnings per share, low end of their estimate, multiplied by their shares outstanding, and I got to a $1.239 billion in net income. So carrying that through, we see that they're expecting to spend $5 billion in CapEx in 2023. That leaves about $1 billion more to spend in Q4. That would give us a free cash flow of $327 million in Q4. Obviously not great, not what we're used to seeing, but definitely not negative either. So that's a 26 cents of free cash flow conversion. Now I'm making a few assumptions here. So let's say they take on absolutely no debt, just as they took on zero debt in Q3 of 2023. They pay out $1.1 billion in Q4 for dividends, $1.18 billion really, and then they don't repurchase any shares. That would give us a cash of about $8 billion. So still well above what their cash target is at $6.5 billion. Another thing to note on this is their debt to equity is 0.64. Well, in Q3 it's 0.66. But if everything kind of holds and their equity increases only 2% for Q4, and look at this, 4.5% increase in Q1, 4.5% increase in Q2, and a 4.3% increase in Q3. If they only increase by 2% in Q4, and they have no new debt, that's down to a debt equity of 0.64. If they put their debt to equity at 0.89, where it's the highest debt equity they had in the last 10 years, that brings us up to debt of $4 billion in debt proceeds for Q4, plus that would up their cash to $12.2 billion. The point I'm making here is that they have a lot of capacity to take on more debt and really not hurt themselves from a balance sheet standpoint very much. On the higher end of that guidance, we have a revenue of $4.27 billion. And based on that $1.57 earnings per share, that comes out to a net income of $1.439 billion. And keeping that cash conversion the same, $1.13, that gives us an operating cash flow of $1.63 billion. Again, with the same CapEx spend, just over $1 billion, that would give us free cash flow of $554 million. Again, not what we're used to seeing, but sequentially, it is an increase. So right now, Texas Instruments is certainly scaring some investors, but I think what we should be paying attention to for the next quarter when they do release their earnings is that free cash flow conversion and that cash conversion. If it's less than what it was this quarter, so if it's less than $1.13 for cash conversion, and if their free cash flow conversion is anything less than 26 cents, then there might be some issues going on there. But right now, I think Texas Instruments is still a hold. I also updated my valuation for Texas Instruments, and I want to show you the growth rates I use. So we already talked about what I'm forecasting for next quarter. But however, in year 2 through 6 for the revenue, I'm going to do 2% growth in year 2 or 2024, 13% here in year 3, 12%, 9%, and then 7% in year 6 and thereafter. And that gives us a compound revenue or a compound growth rate for revenue of 5.5% over the next 10 years. Earnings per share, I'm projecting a decrease actually in year 2 and 2024 of 5.5%, but then this is going to bump back up in year 3 to 20, then 30%, then 10.5%, and then 10% thereafter. And these numbers here, by the way, are based on analyst estimates from Wall Street. So I'm not just making these numbers up willy-nilly. And these are based on my low end, the low end of the management guidance. So I'm not using that high end. I'm being on the conservative side here. And the last thing I want to point out here is I'm using a 30 cents estimate for free cash flow conversion starting in year 2. All right, so that means they're going to convert 30 cents of every dollar of net income they earn into free cash. And if we look at it like that, after year 3, they'll start increasing that back up to the normal levels we're used to seeing with Texas Instruments, especially if they're going to be growing that earnings per share by these amounts here. And that would give us a free cash flow growth rate of 7.53%. So how does this affect our final valuation? Well, I'm using 3 different methods here. So discounted cash flow, it's $172.50. I'm using an 8% discount rate, by the way. And for a dividend, I have $171.83 as a valuation price here. And I have $150.87 for my exit multiple. And that valuation average comes out to $165.95 per share, which is about 15% higher than the current share price. However, that margin of safety at 20%, that would mean an acceptable buy price of $132.76. So if you currently hold shares of Texas Instruments, it's probably best to hold for right now. There's no reason to sell. I think that dividend's not going to be in any jeopardy anytime soon unless something really goes bad for them. But if you're looking to start a position, you might want to wait because if we're being honest here, the price may come down a little bit more. The general economy is not great and investors are pretty scared right now, especially in the tech sector. So after this latest earnings release and listening to what management had to say, as well as going through a lot of different numbers, I'm still comfortable in my investment in Texas Instruments. I don't see any reason to sell or get out of that right now. However, I will be monitoring it very closely over the next couple quarters just to see that they are in fact increasing a little bit, even if it's just a few basis points and like things like operating margin, gross margin, earnings per share up a little bit. I do want to see some growth, but there's no reason to panic. Everything is going to be fine for right now. All right, so before we go, I do want to emphasize that this is not financial advice, and I do own a fairly large stake in Texas Instruments. So thank you for watching today's video. But what do you guys think? I love the feedback, so let me know in the comments below. And if you find this content helpful or useful in any way, please hit that like button and don't forget to subscribe to the channel. Thank you and happy investing.